So this is our FICA. 7.65% is how much is taken out of your paycheck if you work for somebody. And let's just figure out how that breaks down. Okay, 1.45% of that is Medicare. This is basically, if you want to think of health care for older people, okay? You've got to be, I believe it's 62 before you can start it, and it basically pays for them. You are paying for the individuals who are currently in the system. So essentially, you're paying for your grandparents to receive Medicare. Okay, this isn't something that your grandparents have put in all this money to, and it's been saved for them so that when they need it, they can withdraw that money. That's not how this works. Okay, it is money that you are putting in that is being withdrawn by your grandparents to pay for their fees and costs. Same thing with Social Security. Only difference is it's 6.2%, but Social Security, you are paying that in right now, and that money that is received from you is paid out to the individuals who are currently receiving benefits. So again, you're paying in for your grandparents. Now, if an individual decides to do that in their private life, it's called a Ponzi scheme. It's illegal. They can't do that. Okay, that's what like Bernie Madoff did. You can't take money from one group and then pay out to another group with the promise that you will pay the group later on. All right, you can't do that. But this is the federal government, so they say it's okay. So this is their exception. They are the ones that make the rules, so they get a little bit, so they get exceptions. So here you go. But this is how Social Security is done right now. There are people who say, well, is Social Security going to be around when you retire? And there are people who say, no, it's not. It's going to be bankrupt. Here's my personal opinion. It's going to be around. It will be there. There will be that benefit. The individuals, you right now are putting money in. The highest voting block in America is elderly people, older people. They're not going to take money away from the highest voting block in America. It's just not going to happen. So yes, it will be there. I'm not a fan of Social Security. I don't think it's a good investment. I would rather take that 6.2% invested in the stock market, have my own retirement fund set up. We would be so much better off, but that is the way it is right now. Okay. And you have to pay Social Security until you reach a certain limit, and that limit changes. This limit here is based on 2020 taxes, so 137.7. So if you make as soon as you make 137.701, you no longer pay Social Security. So if you're making 150,000, you pay Social Security on the first 137.7 that you make, and anything in addition to that you do not pay Social Security on. Remember that you pay that and your employer matches it. So at Heritage, I pay 7.65% and Heritage pays 7.65%. Okay, so if you are self-employed, congratulations. You are the employee and the employer. You have to pay double. So you must pay, that's 15.3%. So if you're looking at starting your own business and being your own boss, you can just understand that you have to pay double of what we call those FICA taxes. All right, capital gains. This is your opportunity to avoid some taxes. All right, I'm going to tell you about this. This is basically when you buy and sell an asset. And specifically, it's used most of the time when we're talking, it's stocks, right? You buy a stock for $100, it goes up to $150, and then you sell it. You made a $50 profit. That's considered a capital gains. Okay, here's our big loophole. You ready for this? Not really a loophole. It's 100% legal, okay? But it will reduce the amount that you pay in taxes. Here is the tax brackets for capital gains compared to the traditional tax bracket. Okay, so over here on the left, this is our traditional tax bracket. That's one we just talked about, right? The first $9,875 that you make is taxed at 10% all the way through, right? Okay, now, if it's a capital gains, so if you're making your money by buying and selling stock, they tax you at a different rate. Let's look at this. For capital gains, the first $40,000 that you make is taxed at 0%. Crazy. Okay, so if you're earning your income by buying and selling and investing in stocks, and that's how you make your income, congratulations. The first $40,000 you make, you pay zero in taxes. Zero, not a dime. Then from $40,000 all the way up to $441,000, you pay 15%, and then anything over $441,000, you pay 20% in taxes. And here's really how Jeff Bezos makes his money, how Elon Musk make their money. They are paid a traditional salary, of course, but the vast majority of their money is paid in stock options. So when they exercise those options, that option is taxed at a capital gains rate, not a traditional W-2 rate. And so, of course, they're making billions, so they're going to be taxed at this 20%. 20% is still an absurd amount for how much money they're making, but 20% here is much less than this 37% that they would pay through normal wages. So if you can classify money and you can earn your money by investing in stocks, and it can be different things too. You could do it in real estate, that type of thing. But there are some caveats I'm going to tell you about in just a moment. But if you can make your money there, you're going to pay a lot less money in taxes. So it's a fantastic way to reduce how much you have to pay in taxes. Okay, so you start to see the benefits here of investing. You know, we're talking about saving money on a regular basis. There are some major tax benefits as well. Okay, remember our previous example here, right? We did Jarius. Let's just take one of these two. We talked a lot about Nathan. Let's talk about Jarius for a moment. Jarius was $6,790 is what he paid. Okay, that was normal traditional income. If we changed it and Jarius made all of his money via investing and these capital gains, and all of his money was classified as capital gains, instead of paying $6,790, let's take a look at how much he would have paid, okay? All right, he still made $50,000. The first $40,000 that he made, though, was taxed at 0%. He had to pay no tax on that whatsoever. He just has to pay the tax on between $40,000 basically and $50,000. And that is taxed right here at 15%. So he's going to pay $1,500 for it. His total taxable amount is $1,500 in taxes. So if you're asking me, would I rather pay $6,790 in taxes, or would I rather pay $1,500? I'll take the $1,500 every single time. So yes, if we can classify our money and we can change the way we make money as investments instead of traditional income, we can really save a lot of money. Okay. A couple things you got to be aware of. These are the caveats I was telling you about. Number one, you must own it for at least a year. In other words, if I buy it this morning and I sell it tomorrow, I do not get capital gains. I have to own that asset for at least a year. A year and 1 day, basically, is what they're saying. So, okay, if you make $600,000 and you own the stock for 15 months, you're going to be taxed at that 20% rate. If you make $600,000 and you've only owned the stock for 11 months or 1 day, it doesn't really matter. Anything less than a year, you are taxed at 37%. They consider that like a day trader. That is all taxed at a higher normal income rate. Okay, so you don't get any tax deduction. It's specifically designed for people who want to invest, so to have that investing money. So that's the other thing you've got to be aware of there. And this one, I just want to make you aware of this. I've preached in this class a lot about investing in stocks, and let's just talk about why. So this is $100 invested, right? We started with $100 before the stock market crash of 1929. Okay, so $100. How much has that grown over? Let's see. It's almost 90 years. 90 years. How much has it grown? Stocks have the highest return by far. Normal inflation is $1,300. Stocks, $726,000 is what that $100 would be worth today. Isn't that crazy? $726,000. So this is why I'm telling you to put your money into stocks, because you do get the capital gains reduction, and it's the best performing asset investment that you can get, with a couple of caveats that are really crazy. This is for the everyday person. Just put your money in the S&P 500. This is what you will get. This graph was provided by Fidelity. They've got a nice system in there. I do like Fidelity. Not the only one that's good, but anyway. I just want to make you aware of that. All right. Types of income. You can have income from just about anywhere. Anything that you get money from is considered income, right? Wages, your normal. Bonuses. Tips, if you're a waiter or a waitress, you get tips. That is considered income. It is taxable. Interest or dividends, of course, that's going to be. But those are taxed at the capital gains rate, so much better. Alimony received. So if I went through a divorce, that's alimony. And kind of like child support, where you pay to support your child, this is spousal support is what they call it. It's paid to pay to help support a spouse. So if you went through a divorce and you received alimony, you have to claim that as your as taxable income. If you win the lottery, that's taxable. If you win a prize, you have those ones. Maybe you're at a golf, and if you hit a hole in one, then you win a free car. You do, but it's considered income, and you will have to pay taxes on that. If you're at one of those shows, Ellen does it sometimes, or Oprah used to do it, where they'd go, everybody gets a car. Everyone in the audience got a car that day. Great, you get it, but it's taxable income, so you're going to have to pay taxes on it. Now, it's still better than not taking the car. Still take the car, It's worth more than what you're going to pay in taxes. You can always just sell the car the next day type thing. But all of these things are types of income. Federal income tax is based on your income minus any sort of deductions that you have. So let's figure out how we can reduce this amount that we're going to owe. So again, we take all of our income here and we're going to reduce it by these items. These are the items that can reduce how much you have to pay in taxes. College costs. Now those are somewhat limited, but you can write off what you're paying for some college expenses. IRA contributions. These are individual retirement accounts. Contributions to IRAs will reduce your taxable income. Alimony paid. So if you are the one that got a divorce and you have to pay your spouse alimony, that can be reduced in your taxes. Mortgage interest. So if you own a home, that's going to reduce the amount you have to pay in your taxes. If you give money to charity, now we've talked before in this class about charity. I'm a big fan of charity. I think you need to give 10% of your income to charity. And as you give that 10%, that is a deduction in your income, taxable income. So that will reduce the amount you have to pay in taxes, which is really nice. It's the federal government's way to encourage people to give to charities, okay? All right, standard deduction for this year. Now this means if instead of going through all of these and itemizing every dollar that you gave to every person, if you want to just make it easier, the federal government has said, okay, instead of doing that for everything, if you want to just take a standard deduction, we'll give you $12,400. So that means if you make $15,000, $12,400 comes off of your amount that you have to pay in taxes immediately, meaning you're only left with $2,600 that you have to pay taxes at, and that's at the 10% rate. So that's pretty good. So instead of doing all these itemized, you can just take $12,400 immediately. If you make less than $12,400, know that you will not have to pay one dime in federal income tax. Okay, you will have to pay Social Security, you will have to pay Medicare, but you will not have to pay federal income tax. So whatever you've paid into that in your weekly or biweekly paycheck, you will get that money back, okay? All right, so let me pull up a pay stub. I'd like to do that, okay? Let's pull up a pay stub right now. Okay, this is a sample pay stub. Okay, and you'll go through here. It's got your statement on it. Pay usually covers about a 2-week period. Here's your pay, right? Your regular pay. If you get any overtime pay, if you ever get the opportunity to do overtime, do it. It's time and a half. You get 1.5 times as much per hour as you were getting before 40 hours. So if you ever get the option, do that. But here's where your federal income tax comes out, $298. Social Security is $68. And this, they just take it right out of your check. So your gross amount, you made $1,000 on this sample pay period, but your ending check, your net pay is $583. So the rest all went to taxes. Now, if throughout the year, that's all you made was $1,000, then you would get this $298 back in federal income taxes because that's under the $12,400 figure that we just talked about. But otherwise, you're going to pay that in your taxes. This is going to be your net pay. Everything else on this one is essentially going to the government, except for 401k, which is a retirement plan. 401ks, I'm a big fan of those. But anyway, so this is just kind of a sample pay stub. So hopefully this was a little bit beneficial. It's a crazy system that we've got, but it's one that you need to know so that you can reduce the amount you have to pay in taxes.